All right, I'm going to kick back into where we are, and we should be going live right now. So, okay, hey everybody, happy April 21st, 2020. And it's once again the Tuesday update for the real estate and mortgage markets with Reba Haas, Team Reba, Remax Metro East Side, and also of the radio program and podcast Open House with Team Reba, and my co-host over here.
Hey, how's it going? Eric Aasness here from Homebridge Financial.
Yes, so here we are again. Sorry, we had a couple of technical difficulties getting in today, but we are here as promised. And if you have questions along the way, please let us know. But we're gonna hit it hard today with updates on, I know there was a lot of new numbers coming in from unemployment as well as oil and whatnot over the last several days. So Eric, I'm going to have you go ahead and start us off today and kind of give us an update of what is going on.
Okay. Do you want the good news first or the bad news?
I guess any news, I don't know.
Okay.
It depends on how depressing or happy it will be.
Let's just say things are fluid. How's that? And speaking of fluid,
like my water.
let's talk about oil. Yesterday marked sort of a historic, not good moment for the oil markets. The March oil contracts hit 1 penny a share and temporarily actually went negative.
Wow.
So although the April and May oil futures are looking a little bit better, they're still hovering around $20 a barrel. Why does that matter to us and with mortgage rates and with our economy? Is because energy is a huge part of the U.S. economy. And so it costs roughly, I don't know, when the oil price is about $30 a barrel, that's sort of a healthy level. If it dips below that, it actually doesn't make sense to pull any oil out of the ground. Right now, because the economies worldwide have slowed so significantly, we have a glut of oil on the market. Every single reserve is full, every tank is full. There's tankers floating offshore full. There's nowhere else to put the oil. And as a consequence, that's why the price has plummeted. Economies worldwide have slowed so significantly. What happens with oil prices is when they go this low, it can be a recessionary event as it slows the economy. That's not necessarily good for the jobs picture. That does, in the long run, have an impact on interest rates, though, and that could cause interest rates to stay low or possibly go even lower. On the other side of interest rates, oh, I'm sorry, go ahead.
Well, okay, no, I'll let you continue on, and if you don't answer my question in the next few sentences, we'll pick up.
Okay, sure.
Jumping ahead of things, sorry.
Okay, so the other thing influencing us right now, of course, we're following the unemployment rates, very, very closely. They're pretty staggering, right now. They're very, very high, and we're going to hit probably 20% mark, with unemployment before this thing is over.
How high?
20, 1 in 5. Yeah, possibly. Yep.
Like as in depression.
Right. Short term though. This isn't the long-term thing. In fact, that's where maybe
that's important to discuss, because for those people who were around during the Great Recession or housing crisis as we hit about 10% at that point. Mm-hmm. And we were saying it wasn't, that's why it was the Great Recession versus the Great Depression, because the Great Depression was more around a 25%.
Right. Okay. Right. And the thing is, and I'm following this as close as I can. This week, both Fannie Mae and Freddie Mac, the big secondary markets for mortgages, are predicting that our downturn in the economy will be short, but excruciating. It's going to be rough, and we will see some dramatic drops in output and everything because our economy's shut down. I mean, it's got nowhere else to go. However, they figure this is going to be very short-lived, and then once we get out of it, we're going to be booming. And overall, right now, they're still predicting that by 2021, growth is going to be up around 5% per year. Our gross domestic product. That's a booming economy.
Okay, so that is super great news, though. So also trying to get perspective on that compared to, say, like the Depression, that took 10 years for us to come out of that, right? And when we had the Great Recession or housing crisis as we know it, that started in kind of, depending on where you were in the world of the United States, it either started in 2006 or mid 2007, really kind of went, some people would say it went on until at least 2012. Some people even say it was through 2016, but we started having a lot of growth. So we had an unprecedented period of growth in at least a 10-year period, right? From 2010 to roughly where we are now.
That's right.
So this, expected to be more temporary situation is, I mean, this is good. So it's not fall off the cliff news, but it's like, ouch, it's gonna hurt. But
it's already hurting. I mean,
yeah, it's totally hurting. Yeah. I'm not saying it's not.
Absolutely. So, and that's the other side of this is forbearances. And, if you have a mortgage right now, it is possible to get a forbearance, most likely, meaning that you can delay making your monthly payments. Give you an idea right now, the number of forbearances is upwards of, I want to say around up to almost 5% of the amount of mortgages out there. In comparison, at the beginning of March, the number of forbearances was 0.25%. So we go from 0.25 to 5% of all mortgages in a month. It's brutal. We're estimating that the missed payments just this month alone total $651 billion. So one thing to kind of think about, put that number in your head. Now think about the loan servicers, the people that you make your mortgage payments to. They are required by contract to forward your mortgage payment to the investors, whether or not you've made the payment. Right now, those servicers are having to front that money, and they can't do that forever. So yesterday, the Federal Housing Finance Administration came out with a mandate that said that the servicers will have to tough it out for 4 months, forward those payments along. After 4 months, if a loan is still in forbearance, then the government will jump in and pick up the difference. That's still carrying 4 months of your mortgage payments without receiving those payments from you. And so there's still some struggles that the loan servicers are going to have. They're relying hopefully on the Fed to come in with some sort of a vehicle, a loan mechanism to help them with their cash flow as they work through it. Otherwise, we could see some servicers go out of business.
Right. As I understand it, I as you know, I'm a member of the Realtors organization, and I do know that they are working on behalf of the industry to try and get some relief for the servicers as well. I was just reading an article about that on Friday as they released that information. And we've talked about, so again, I love to give context for people because, as you know, housing is history. I want to give some perspective to that. Would you say 4 or 5% of those loans in forbearance right now? So 5% in forbearance, but everyone, I want you to make sure and kind of put this into your thinking as well, though. During the great, our housing crisis, we had 1 out of 10 mortgages in default, which is different than forbearance. Right? We had people who were losing their homes. Forbearance is not about losing your home. It's about a delay of payment. And so that is a very, very different kind of situation. And I'm not trying to be Pollyanna-ish about it. It's about perspective and understanding what's actually really going on. And so we're trying to provide perspective on that because we've both been through it. Eric's been through more than me, which is, why you see that shiny little bald pate of his. I still have natural hair color. Thank you very much. I don't have to worry about my stylist not being available to me right now, apparently. So I'm feeling pretty lucky about that. But we're trying to put this information out there because we want people to understand, first of all, you need to be current if you're going to ask for forbearance. So don't make assumptions because we have heard disturbing news that in some cases when people are calling their lenders, that they're being told to default, that they won't even give them an option until they default. And that is old thinking. And I need to make sure that anyone who's watching this goes extra steps because that person you're talking to from a call center is far, far, far removed from the people who are making decisions right now. And so you have to go up the chain and really find out, or get on the website and take a look at the information. Do not just immediately take the first person you talk to's word for it, because they may be woefully wrong and put you in a very negative situation.
Right.
We had Rental Housing Association on one of these calls with us a couple of weeks ago, 2 Fridays ago, actually. And if you have renters and you're a landlord or you are a renter, I want to remind everyone that you can go to rhawa.org, where you might want to find some documentation there, because it's not just homeowners, but all the renters are getting impacted, which then means their landlords are going to be impacted. And there's some great documents there that if you guys have arrangements around things that help you kind of try and stay legal in your way, but then also communicate, because your landlord can't help you if they can't get help themselves, right? And even though there are all these eviction, like they're holding evictions, moratoriums, all that kind of thing. Like, first of all, if you can't afford to pay, please don't put somebody in that position falsely. This is a time for people to be very upfront, and those who need the help should get the help. Don't take advantage of what's out there. Okay. Do the right thing and make sure that you're in communication. Because even if you can get through another month or two, start talking with that landlord about what the situation is going to be, because they're going to need to document just the same as a regular homeowner, like why they're doing this. They're not just going to take everyone, they will initially take people's word for it, but they got to follow it up. You got to follow that up with documentation. So these are interesting times for sure. They're not the worst of times. They are painful for many. And we do not sugarcoat that one iota. Everybody's, there was a great thing I just shared on Facebook the other day, that we can't say we're all in it together, like we're all in the same ship. Bullshit. Sorry, I'm going to use curse words here. We're not all in the same ship. As this little statement read, we're in the same storm, and it's affecting people differently. So we're all in it in terms of there's like a bunch of chaos going on, but we've got to be realistic about who is it truly impacting. And this is not the time to be the people who take advantage. And if you're in a position to help others, please do so. There are so many organizations. There's a lot of people bored out there. Well, guess what? There's a bunch of nonprofits and organizations who could use your help right now. And again, if you're in a position to give time, give effort or money, any of those things, 20% of the population being out of work is no joke. There's a lot of, like, we get the memes are funny, they try and keep it light, but don't disenfranchise others who are truly, truly going through some situations. So, so I'm getting a little deep. I'm gonna bring it back to you, Eric, because we're trying to give perspective. We're trying to give information. Give us some more information about what's going on in those markets.
Sure. How about some good news?
Oh God, please, because I just got super intense and probably scared the crap out of everybody.
Well,
first smile.
Yeah, we do. Fortunately, the real estate market is open. That's yes. A good thing. We have. I just wanted to shout out my staff are amazing, and yeah. we just finished a record month in March with everybody working from home. They're just rocking it. They're just incredible.
Now, when you say record month, you're probably talking a lot about refis.
No, it's a combination. I mean, there's been some purchase closings as well going on out there, although we've had some fallout. I will be honest. We've had some purchases that canceled because of folks, being put on furlough. Mm-hmm. And so they'll come back. Those will be back around. But refinance activity though is extremely high right now. With the rates as low as they are, mm-hmm. and the rates are still staying relatively stable. Right now, the national average, if you're looking at a 30-year fixed rate conventional mortgage, we're hovering right around 3.375%.
That's right. I forgot. I'm tracking these. 3.375. Okay, hold on.
So those are for conventional.
I can't see anything.
Oh, you got your chart there.
Yeah,
wow.
I keep tracking this. Keep talking, 3.375.
Yep. And if you're looking at government, VA loans right now are at 2.75 if you're a veteran. If you're a veteran and thinking about buying or refinancing, boy, now's a really good time to do that. And you know what? That's just kind of between us. If you're a veteran and you have a VA loan now and you want to refinance, if your rate is higher than about 3.25%, even if you are furloughed from your job, a VA, you can still refinance.
Ooh.
Conventional loans, you cannot. On a conventional loan or FHA loan, there's a certification you sign. You have to be actively employed. VA, just for what's called a streamlined refinance, there is still a little bit of a way to get around that.
Okay.
So that's something that we've been tracking very, very closely. And as of today, this could change tomorrow, but as of today, that's the rule. Jumbo mortgages are still struggling a little bit higher. We're sitting around 4.25% for jumbo 30-year fixed rate loans. So those are ones where, because there's no active secondary market, Fannie Mae, Freddie Mac for jumbo loans, those loans stay on the books of investors, and there's just not an appetite for them right now. So we are continuing to see those rates stay a little bit higher. But everything else, we've adjusted our appraisal processes and things where in most cases, we do not need to have an appraiser go inside your home. So we can do outside exterior type appraisals. And on many refinances, we can do what's called a waiver. And even on some purchases where we don't even need an appraisal at all. So if your file is strong enough, then we can bypass that. So, we've retooled and adjusted and adapted to try to keep things moving along. And but rates are thankfully staying very steady, very stably low.
Can I prove that point for you? Okay. So while we've been doing these, from April 3rd, from when we first kind of started, conventional at that time, you said was 3.375.
Yeah.
I did, this was all like the pending and sales, whatnot, but this was our conventional rates at that time. April 7th, that following Tuesday, VA was still at 2.75. And you had conventional running from about 3.25 to 3.375. And then here we are a couple weeks later, and we're at pretty much the same place.
Right.
I mean, you're spot on. I mean, we are staying very level, which is great news. And I know I can't have a single conversation with a past client that doesn't involve talking about this. I'm uncovering lots and lots of people that we've worked with in the past, or people who you weren't even the lender, and I've just said, holy crap, you're at like 4.75. Why are you not looking at a refinance right now? Yeah. Especially when you've got these situations like, oh my gosh, please, let's get you in touch with your lender.
Yeah, it's a really good time to be doing that for sure.
Yeah, 100%.
Now, the rates are low because the Fed is intervening in the markets, and right. So we do need to bear that in mind. If the Fed decides to taper out, which this week so far they've backed out a little bit, we're still hanging in there with rates. But if the Fed, fully backs out, then we could see these drift a little bit higher. But so far so good. They've been tapering for the last 2 weeks, and we're still staying low. So that's a very, very positive sign.
Yes, we like
coming back around. Yeah,
like that. So I'm going to. So are we pretty good with your stuff here? I actually have somebody who has a question.
Absolutely.
And it's not a lending question, but I'd be curious to hear your take on this too. So June, thank you very much for chiming in. And Raja, hi, good to see you, my friend. June has asked, what is our take on home values for people in West Seattle due to the bridge? So this is not about what's going on with rates, but what's going on with like the local, infrastructure, right? So June, I'm going to give you my own personal viewpoint on it. I don't think it's going to have that big of an impact because you got to think about who's living in West Seattle. Now, there are a lot of downtowners, but there are also different ways off West Seattle than just using the bridge. Will it become a pain? Yeah, it's going to be a pain for a couple of years. However, here's the thing. People who move to West Seattle move there for a reason. And it's because they don't want to be in some, it's a very distinct neighborhood. And it even has lots of its own pockets because West Seattle is actually a pretty darn large geographic area. It's kind of like what we call Area 705 up in North Seattle, which encompasses basically anything from I-5 west out to the Sound, from basically north of Lake Union all the way over to up as high as 145th Street. So West Seattle, covering from Alki Point all the way down to Fauntleroy and even a little bit south of that, each area is going to be impacted differently because there's actually quite a few people in West Seattle who don't even work in downtown. There's a lot of traffic that goes across the bridge because there's still a lot of people, so we're going to see some interesting things going on. But right now, when most people are working from home, they're probably loving being over in West Seattle right now. It might impact what kind of home people want to buy over there. Because if they are going to be a work from home kind of person, they probably will want a home that provides them that opportunity and space to have that. But in general, West Seattle tends to draw a certain personality type. And I don't think that's going to change in the 2 years that it's going to take to do all the other stuff, because everyone said the same thing about the viaduct and people still worked around it. West Seattle, as you know, June, has grown by leaps and bounds, even while the viaduct project was going on and was massively delayed. So we still have so many people here. And what you're also missing out on is how much other growth is happening in areas south of the West Seattle area, where that area is still considered a very viable, vibrant community that people want to live in, even if their jobs are south. So I don't think you're necessarily, you might have a little bit of dip, but I mean, we're going to have a little bit of dip in appreciation everywhere right now, because we're about 20 to 30% down in the number of sales in general, but we're not seeing it collapsing here. We're still running a very low inventory rate here. I mean, before all this stuff happened, we were in some areas sub 1 month of inventory, and in other areas about 1.5 months of inventory, which is excruciatingly low when you're trying to work with buyers and find places. And we're still running into multiple offers. I've had them in Puyallup, downtown, Boulevard Park. West Seattle is still a very popular place to live because it's got a great quality of life. And
still a shortage of inventory compared to buyers.
Exactly.
As long as that continues, I wouldn't see the prices dropping that much.
Yeah, I don't see that happening anytime soon. I have a bunch of people who keep saying to me, hey, I'm going to wait until I see the prices drop. And I'm sorry, but I just don't see it. Now, the least interesting houses may have some issues, but you're not going to see the stuff that's, great properties. In fact, here's one of the things I also want to, I'm going to go back, pardon me, as I look like I'm slightly distracted. I'm going to share my screen like I've done in some of the past episodes of this. And okay, here's my little market watch, 7-day kind of forecasting. Here's what's going on locally. Now I'm going to give some comparisons. So we see in the last 7 days in the MLS, multiple listing service. For those of you who don't know it, this is the Northwest Multiple Listing Service. New listings is 1,459 in the last 7 days. And that is for the entire MLS area, which is about 35 counties in this state. Just to give you some perspective on that, we've been watching what's going on. So April 3rd, there was 1,337 new listings. And April 7th, there was 1,246. So there was not a lot of movement in just a few days. Pendings, though, let's take a look at that. Pendings on April 3rd were 1,850. And on April 7th, we listed those at 1,750. So we had seen a small decline as we saw things going on. Look where we're at right now. 2,508. That is definitely showing activity. Now, what we do see here though, listing price reduced. That's up another 100 from what it was last week. So we are watching the price reductions increasing, because on April 3rd, we were at 507 for that number. And then it went to 624. So some people are, getting their expectations in check, let's say, perhaps. But we're still seeing, but see, there's even like price increases, right? That's 139, where back on April 3rd, we were at 125. Back on market, 324. Back on April 3rd, that number was 431. So these numbers are still showing that we're going to have a lot of very viable market activity. As far as I can see, the fact that this pending number is so high, it's good because it means people have gotten through their inspections. Because I will tell you, there's fewer of those waive your inspection situations going on in offers, because people are being a bit more conservative and doing less of that. But when they get to pending rather than pending inspection, it means that they have passed one of those two major things that are the hurdles within real estate, which is inspections and financing. Now, the listings sold, we're at 1488. As we went into all of this, as Eric and I have mentioned before, we had 17,000 active transactions underway at that time. So we're still kind of going through that period right now. The number of solds back on April 3rd was 1,819. So that number is actually down a little bit, but that's because we also had 2 weeks of very slow activity. We had 1 week where a bunch of deals fell apart because of everything starting to happen and people freaked out. So that's not a surprise that some of these numbers have gone down because they didn't have replacement deals coming in. But I'm going to be watching that over the next couple of weeks. And my expectation is that this number will start creeping up again over the next 2 weeks as we see more of these deals getting to fruition. Because once they're pending, they're probably at least a good 1 to 2 weeks within the transaction timeline. And so we're going to see this number starting to increase as long as they don't fail out from financing. Do you have any other comments that you want to put in on that, Eric?
No, I think that makes perfect sense. And, we are seeing some, fairly good activity, good purchase activity out there. A lot of folks are looking at getting pre-approved and getting back into the market. So far, so good with all of that. Yeah, we're super busy right now. I mean, anecdotally, and I know that's just for us, it's not absolutely everyone. I'm talking to other real estate agents who like their business is just, gone away. But sorry. I can't tell if I lost you or not. No, you're still there. You're definitely still there. We just somehow lost your video feed, Eric. But what I want the people, but what I want people to know is that, for those of us who really look at this as a true profession, and I say that from the real estate side, because on the lending, they're in their offices, they're essential workers. We're limited essential, as long as, we're following the rules and cleanliness and all the other sanitizing and all that kind of standards. But I will tell you, those people who truly see this as a full-time career like I do, we're humping it big time right now. We are in touch with people. We are moving things forward. We are getting lots of information out to people. We're helping our clients who are looking at doing refinances, getting an idea of where their market valuations are at and so forth. So I think we may have lost Eric on that. So sorry about that. If you have any other questions for him, you can put questions down below in the comments, or you can also email Eric at ericismybanker.com. That's ERIC at ericismybanker.com. You can also reach him by cell phone at 206-915-3742. And for myself, if you have any questions for follow-up, whether it's about market data, price points,
what's happening in general in the Puget Sound region, because we cover multiple counties here, feel free to reach out to me and my team. My personal email is reba@teamreba.com, or you can do it generally to info@teamreba.com, and that will get to almost all my team so we can get to you right away. And my personal cell is 206-910-3429. So again, you can leave comments, send your likes here, anything, any questions you want us to follow up. We're going to do the next one of these on Friday, right around 1 o'clock, barring any technical issues, but it will be around 1 o'clock. And thank you for anyone who's been watching or gets a chance to watch this after the fact. We love being here for you, and we'll be here for you as long as you need us. And let us know what you need. Happy to help any way we possibly can, or help make connections for you, because there's a lot of other resources out there and organizations with whom we interact on a regular basis. So anyway, take care, everyone. And thanks so much for being here. Bye.